they kept on going until they wrecked the system. And now the subprime bond is the U.S. Treasuries.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and today I have a special treat for you. One of my favorite analysts to listen to. I mean, some of the things that he comes up with years ahead of anyone else, truly stunning, and it's an honor to have Jim Willie, editor of the Hat Trick Letter, which you can find at golden-jackass.com. And I'd really suggest after we wrap up here today, going and checking that out, because what Jim does is truly incredible. And before we get started, hit the subscribe button so you can stay posted when we have Jim on. And with that said, Jim, really a pleasure to have you on here today. And how are you doing, my friend?
Doing okay. I can actually say that we are kind of buddies, because we talked for a good long spell before we began recording. I like to talk a little bit with the host in the first show, and got an interesting background, Chris, and so do I. It's a long path that brought me here to Costa Rica, and right now we're dealing with the Lehman Redux.
Yep.
We fixed nothing. Everything that we did wrong in 2005, 6, and 7 that led to Lehman, you can't blame Lehman. Lehman was just the biggest investor in mortgage bonds, and therefore they had to be killed. They were killed. They didn't die. They were killed. That was a financial bag put over their head by J.P. Morgan and Goldman Sachs that killed them. And then they murdered AIG in order to give benefit to Goldman Sachs. 100 cents on the dollar on the credit default swap. But the major point is that the mortgages were subprime bonds back then. Right. And I actually gave a year warning for Lehman Brothers and a big crash. And I gave a 3-month warning specifically for Lehman Brothers and Fannie Mae. I got 2 of the 3 correct. And the voice told me, Jim, I don't know anybody else out of 20 people I've asked. Nobody got any of the 2 right. You got 2 of the 3 right. So you're doing something right. You're doing something well. But every mistake that we had, that we committed in 05, 6, and 7, leading to Lehman, we repeated. And we did it on a bigger scale. And we did it with more banks involved in the corruption. I call them lashed, tied together. Let me explain that briefly. On the old colonial days, we had sails on ships, and they had to be very careful about storms that would whip them around too much with the sails being exposed. They had to bring the sails down in order not to be whipped around, so that only the masts were there on the ship. And those men who were on board had to tie themselves together against the mast and the side, I don't know what they're called, the big rails on the side, so that the winds and the waves didn't knock them overboard. There were a lot of men who went overboard and were killed. Okay, so after 08, at that time, Morgan Stanley was the designated hitter for derivatives, interest rate swaps. And after that, it's all shared with like 10 different sci-fi banks. And I kind of laugh when I say that. Not science fiction. SIFIs, systemically important financial institutions. So about 8 or 10 banks now, including some Europeans like, Societe Generale of France and Deutsche Bank of Germany, they're all lashed together. Now, some people might think, oh gosh, there's your safety mechanism. I say no, because they kept on going until they wrecked the system. And now the subprime bond is the U.S. Treasuries. And I coined that phrase about 2 years ago, and I'm glad that I'm starting to see it more and more used. 4 years ago, I forecasted the expected arrival of what I called the Scheisse dollar. the new Scheiss dollar. Scheiss is German for S-H-I-T. And in Scotland, they say S-H-I-T-E. But Scheiss got translated with a T in the United States and England. And so I was forecasting starting about 2017, 16 actually, the new Scheiss dollar, which I thought would have a fake dollar basis. I'm sorry, a fake gold basis, fake gold back. And I think if we do launch a new dollar soon, it will have a fraudulent gold backing. We will advertise it as a gold backing, and it will not be gold, and we will interfere with the independent audits, and we're going to buy a couple of years' time. But let me describe what's happening now. They've run out of time. The Belt and Road Initiative is well along, led by China. We did something really stupid, but it was desperate. It sort of had to be done. We identified Russia as being bad guys. We blamed them for the Ukraine uprising and coup when the United States and Israel did it. We blamed them for capturing the Crimea when, no, they turned Russian after 95% positive for the referendum. That's not in the US news. So we managed the Maidan coup in Kiev, Ukraine, stole their central bank gold, passed out 10,000 vials of amphetamines, and had snipers on the roof. And then we blamed Russia for annexing Crimea when they chose to go to Russia. So we imposed sanctions on Russia, and that was a very big event that has had very big consequences. The major consequence is that it began the de-dollarization movement. They quickly, in Russia, signed a big deal. It's like a 10, 15-year deal, maybe more, $230 billion energy deal where a big pipeline, the Power of Siberia pipeline was to be built, and it's now completed. And they're building little branches now off it, not little, but major branches off it. That deal is called the Holy Grail deal because it's so big. It's the biggest in history. There's been another one almost as big with the Chinese, the United States, for exploiting Alaskan oil, which I think will never go to the US market. I think our debt problems have resulted in losing all the Alaskan oil and probably all the Alaskan minerals. Okay, so in 2014, the whole Russian sanctions began. And at that time, the Iranian sanctions were still alive. No Chinese trade war was in place. So there was an entire Asian movement toward the de-dollarization. And that basically meant that they were going to remove the dollar from trade payments, and they were going to slowly migrate away from the treasuries in their central bank reserves. And it's really grown enough to make some serious dent in the dollar proportion of trade payment. And now I think there are a lot of lies. I think there are big dents, big changes and reductions for usage of treasury bonds in central bank reserve management. I think it's a lot lower than what they say. Where do you get the data? You get it from the US government. So are they likely to lie? Uh-huh. Do they lie about just about everything? Uh-huh. Do they lie about the economy? Uh-huh. Do they have legal backing by the Congress to lie on their accounting statements? Uh-huh. Do they lie about Pentagon spending? Uh-huh. Is the proof in the $21 trillion in missing money from Skidmore and Catherine Fitz? Obviously, yes. Okay, so the US is now being internationally labeled as a rogue state from a financial standpoint. And the de-dollarization has turned into open hostility in dumping the treasuries. I believe, for instance, that the Chinese don't have 1.0 trillion in treasuries. That data comes from the US. Now, if the Chinese are doing swaps Like, well, I'll just give you an example. They might say, well, we're going to put up 100 billion and we're going to get a consortium of banks from Germany, England, and France to back this and allow us to neutralize our dollar risk and swap it over to a combination of euro, Swiss, and British pound risk. Who's going to be hearing about it? Exactly nobody. So I think the Chinese have swapped out of a good portion of their dollar exposure, and it's only compounded the whole issue. Let me just one little funny item because it's now becoming a standard model. In the Power of Siberia Russian pipeline system that reached down into China to deliver oil, for which, by the way, they're paid in gold and yuan, mostly yuan, which they can convert as much as they want into gold. The entire pipeline was paid for by Chinese-owned U.S. Treasuries. It's called indirect exchange, and it's becoming a very big factor. There are other methods of dumping treasuries, like, for instance, there's a country, Angola and West Africa. The Chinese give a few $1 billion a year to the Angolans to manage their budget, manage their, their criminal fraud and whatever. Okay, the Chinese deliver a couple billion a year to the Angolan government. It's paid back in yuan because Angola, being an OPEC member, sells oil, and they do so at their discretion in yuan, RMB. I use RMB a lot because I like it. It's renminbi. It means people's money, but RMB is not confused. Okay, there are three Asian currencies and they're major. The Japanese yen, the Korean won, and the Chinese yuan. And I don't like the confusion, so I prefer RMB. There's a lot of usage of RMB now in the Belt and Road Initiative for building bridges, railroads, port facilities, you name it. They spent $25 billion, the Chinese did, in Pakistani ports. So this is not about the Eurasian trade zone being land-based. This is the Chinese moving into Oceania and the British domain, a la George Orwell. They're going to be building Iranian ports, and they've already started. They've got the Pakistani ports. I believe Iranian ports are going to be way stations to go to Djibouti, which is their major African port. The Chinese are going to be all over the place. The Chinese are now embarked, and I think they're still using their treasury bonds to do the purchasing. The Chinese had a big deal with Greece recently. They had a big deal with Turkey a couple of weeks ago. They had a big deal with Italian ports 2 months ago. They're trying to buy the port facilities that control the Mediterranean. It's going to be a very big strategic area because once they do, they can develop North Africa, right, which the globalists have been blocking by means of murdering Gaddafi, stealing 140 tons of gold that the British will never return. I mean, it's kind of funny when you watch the British bankers ply their trade in fraud and theft. They said, we're fully willing to deliver and return the Libyan gold, but we've got these 15 requirements, which will never be met. Okay, it just goes on and on and on. And some of the other chicanery. The New York Fed at one time housed the German and the Dutch gold held on deposit, custodial role, and the Germans demanded it back. So we just, launched the Langley War in Chad and Sierra Leone and another country I can't remember in northwest Africa, and, killed all the locals who tried to get in the way, bribed some of the officials, and hey, here we go. 5 years later, ahead of schedule, we repaid the Germans. This is how we operate. Nope. The U.S. government and the bankers are a gigantic criminal organization, and that is the fact of life. Their fraud related to the Lehman era, the Lehman events, that's how I call it, but you got to be fair to Lehman. Lehman was murdered. Lehman was killed. What did Lehman do? Lehman had a few very big sales of mortgage bonds. They sold them to Goldman Sachs and JP Morgan. I hear that the amount was around 2.5 billion or a little bit more. And Goldman Sachs and JP Morgan never paid them. So it caused a liquidity crunch of an immediate nature for Lehman, and they had to enter failure. They had to admit that they were broken and broke and bankrupt. And the rest of Wall Street was saying, "Oh gosh, they must have made some really stupid mistakes." And we didn't. No, they did not commit crimes. They did not kill other firms. They did not commit multi-million dollar fraud. So, what's happening now is we've run out of time. We've run the course. We've got debt saturation. You've got, complete overusage and exhaustion of central bank tools. How many times are we going to hear in the last year and the current year, the rest of the year, and maybe a few months after that, that the central banks have exhausted their methods and their tools and they're out of ammunition and we don't know what to do now? Well, what they're going to do is they're going to manage the next crisis. And that's what's begun. Let me take a little water break here because we got to migrate now from the whole background of the crisis to the current situation in the bond market, which I claimed back in December, January, and February would come in several months. And now it's here.
Yeah, and as you take a sip of water there, I guess the next question that comes to mind that maybe you can dig into is, are we going to see things could just continue unraveling the way they have been, where it's happening, yet there hasn't been that moment that everyone on the planet notices, or is there going to be a Sunday night reset, or how does it play out from here?
Well, let me remind me of that as I can work toward it, okay?
Sure.
I don't want to start with that because let me describe the current situation, and we'll get to that, to be sure. What's happening now is scary. Remember in 2012, we put on the QE, the quantitative easing, which is a nice way of officially sounding the unlimited bond purchasing, where we buy our own debt and we use the central bank as a conduit. We buy our own debt. Well, who last did that with disastrous consequences? Zimbabwe. Okay, so we are Zimbabwe. We're Zimbabwe on steroids with a AAA rating. That's what we are now. Okay, so I correctly forecasted QE a year in advance. 2010, I said we're going to go to QE just like Japan. I was called stupid, just like I was called stupid in 08 when I said we're going to go to 0%. Right. I said we're not only going to go to 0%, we're going to stay there for several years. And when we went to QE, I said we're going to go to QE because we're going to run out of bond buyers and we're going to have these trillion-dollar deficits every year. I was called stupid, and we got both right now, by the way.
Yep.
And I kind of enjoy being called stupid. I call them back. I write back and say, no, the idiot is you. Take a look in the mirror. You're the biggest fool in the room. And I doubt you'll be contacting me in 3 to 4 or 5 years when you're proven wrong and I'm proven right. So get lost, leave me alone, don't write back because you're a moron. Okay. We've been hiding the volume of QE, the bond purchases. Mm-hmm. We've been hiding it in a very big way. When we first admitted that we were doing QE and we announced it all back in 2012, we were saying that it'd be $30 to $40 billion a month in Treasury bond purchases. Well, that's $300-400 billion a year. Well, that's a lot. And I asked the question, do they get rid of it or just go on the balance sheet and never come off? Well, it apparently does go on the balance sheet. It does not come off. And it gets worse. It grows. So during QE, the Fed balance sheet went, I don't have the exact starting figure, but I think it was about 1.8 or 2 trillion, 1.8 or 2 trillion, and it went all the way up to about 4 something.
Right.
Or maybe it was 3.5, 3.7. The Euro Central Bank went even bigger because they were buying corporate bonds at the same time. Okay, now there was a big debate in 2013, 14. How much are you really buying per month? And they would lie and say 40, 50 billion when it was really like 70 or 80 billion. But if you counted the derivatives, it might have been closer to $1 trillion a month. Okay, so they lie a lot. They can't tell the truth. It'll cause a panic. It'll cause all the honest fund managers to abandon. And it would cause a bank run, and it would cause a global run on the dollar. So they have to continue lying, and then they brought about that new financial national security law. I don't know the official name for it. It's not FASB 56. I don't know exactly what it is, but it basically says that financial firms on Wall Street and other places can lie about their financial status in order to keep the country safe. And it was kind of funny because a year or two after that came the revelation of 21 trillion in missing money, done by Skidmore, the Michigan State professor, and Catherine Fitz, the Solaris fund and newsletter editor and analyst, and chief head and bottle washer. She's a brilliant analyst, and the price she had to pay was surviving 3 poisoning incidents, and had some of her bank accounts ransacked. But that's another story for another day. Okay, so move forward toward 2016, and the clowns decided, in control of the central banks, it's time to tighten and reduce the balance sheet because the economy was doing so well. No, because they were lying so effectively about the condition of the U.S. economy. John Williams of the Shadow Government Statistics has put out a statement recently, I think it was a couple months ago. He said since 2005, there have only been 2 positive GDP quarters.
Right.
Excuse me, 13 years? Like 150 months? Multiplied by 4. 52 quarters and there are only 2 positive? Well, now Trump is losing his credibility by saying the economy is doing well. The Fed is losing its credibility by saying we're not going to lower interest rates as long as we've got this strong economy. I mean, you got to laugh, you got to puke. I don't laugh and puke. I got diarrhea over in the corner. I mean, this is laughable shit. We cannot lower the interest rates, even though we must. Okay? Here's a reason why we must. If we don't continue to have a bond market rally, in other words, the principal value of bonds rise, we're going to invite an abandonment. And if the rates don't come down and they actually go up, we're going to invite a revolt. And I think in the last couple of years, we have had some periods where the interest rate, the 10-year yield has gone up. And we have seen some revolt. And it's been from the East. They're dumping the Treasury bonds. Okay. My belief, firmly held, is that in the last 3 years, the derivative coverage has gotten out of control. What's changed? What's the big phenomenon in the last 3 or 4 years? The petrodollar has been extinguished. The linkage between the crude oil price and the dollar, euro, pound, it's vanishing. So all the supporting apparatus had to be dismantled. And these are the trillion-dollar derivatives. And that's only half of them. It's the currency-based petrodollar derivatives tied to oil, which invites the name and promotes the name of the petrodollar. And for me, I call it the de facto petrodollar standard. Gold did not back the dollar in 71. Oil did, but in an indirect way and therefore de facto. De facto just means out of fact, out of deed. So indeed, the dollar has been backed by crude oil, but not since 2015 or so. So there's a lot of derivative I don't like to always use the word dismantlement. Liquidation. They needed to get rid of and liquidate and buy and cover and dismantle, take apart the entire petrodollar derivative system. So I believe that what we've had is $1 trillion or $2 trillion a month for the last few years, covering the derivatives. Now, here's some evidence that backs my point up. Back in 2000 and maybe 12 or 13, we were told that we had about $1.4 quadrillion worth of derivatives in notional value. Let me just move that. We had 1,400 trillion in derivatives for notional value. Now we have half that. So in maybe 6 or 7 years, call it 7 years for easier napkin math. In 7 years, we've got 700 trillion less. That's about $1 trillion a month. Okay, 10 trillion a year. We don't hear about it. If it's not petrodollar derivative, then what is it? I'll tell you what it is. It's fortification of the support for the dollar with the Treasury bonds, the interest rate swap derivative, the IRS, and that's not Internal Revenue Service, the IRS swap. I believe that's been coming on like gangbusters to support the dollar, keep the system going, and allow some fabricated demand of large scale volume to buy the Treasury bond. Let me give you an example from back in recent history. And this is the basis of one of my wrong forecasts. I got a few. I'm running at 90% or so correct forecast. Wall Street's running at 25 or 30%, but they're paid a lot better than I am to lie. I'm paid less to tell the truth. But back in 2009, Morgan Stanley, which was the designated hitter for the derivative complex, primarily financial derivatives, in particular the interest rate swap derivative, Morgan Stanley put on $8 to $9 trillion worth of interest rate derivatives in the period of about 9 to 12 months.
Right.
At that same time, the U.S. government deficit ballooned up to $1 trillion, as I forecasted, and at the same time, a lot of different sovereign entities, which is a nice way of saying foreign central banks, stopped buying treasuries. And that's why we went to QE. But the important event, while Morgan Stanley was putting on $9 trillion in interest rate derivatives, we had a rally in the treasury bonds when our supply went up and our buyers went away. More supply, less demand, and a rally in the bonds? I don't think so. So there's a third agent in there. It's called Morgan Stanley with their interest rate swap derivatives. So there's my argument for their presence. I made my argument for $1 trillion a month. People think, oh, that's ridiculous. Oh, really? Where'd the 700 trillion go? That's a lot of beans. Yep. $700 trillion. Yeah. That's like 70 years of global economy. I mean, come on. No, not really. It's like maybe 25 or 30 years of global economy. The math gets tough. When I get a lot of zeros, I have to be careful with my math. I do like the old chemistry we did with the slide rule. I go back to the slide rule. 1969, I graduated from high school, and we were great at using a slide rule. But what you had to do is take the principal numbers and then count the zeros. So it's this times this times this times this times 10 to the 3 times 10 to the 6 times 10 to the 4, 10 to the 13, and then you bring them all together. Okay, you have to be careful with your zeros. And my usual exercise in being careful with the zeros is, what's the value of a ton of gold? If it's X per ounce, well, it's okay. That's easy. Yeah, well, try it. Let me know if you're wrong by a factor of 100.
Right.
You might not have managed your zeros all that well. Okay, so fast forward a few years, you've got more abandonment by the foreign sovereign entities, the central banks. You've got more supply. and you get continued bond rallies. So you have constant interest rate swap derivatives at work.
It's even like when Russia sold their treasuries last year. I mean, they announced it after they did it, but I looked back the period which they did it over, the treasury market rallied, and it's like you said, it just doesn't add up with the narrative
Well,
they're giving.
there's a story behind the Russians. They're very clever. They've got London bankers working their accounts. This is not like they're all alone in the distant, wintry Russian forests. Not at all. What the Russians did in one of their recent moves, this is about a year ago or maybe 10 months ago, they said, we just got rid of the last 46 billion in our treasuries. No, they didn't. They got rid of their exposure. This is very different. It's complicated finance nowadays. What they did was they put up as collateral $46 billion of treasuries. The Fed bought it. U.S. government, Department of Treasury bought it. And the Russians said, we got that collateral. We're going to buy gold with it now. We're going to borrow against it and buy gold. They didn't sell it to buy gold. They put it up as collateral. They borrowed it against it. They bought gold with what they borrowed against it. That's not the same. It's reducing your exposure. And I think lots of countries are doing that to allow the U.S. government to lap up, soak up, and gather in all the dumped treasuries so that our computers can buy them. We don't have any buyers. We're monetizing all our debt practically now. And we put a gun to Japanese heads so they can continue to buy. Oh, there's going to be a change of events, change of the guard in Japan. That could have an effect on the U.S. Okay, so fast forward today. I'm trying to get an evolution here. I started with pre-Lehman, got to Lehman, got to the QE time point, got to the middle of QE, and then, okay, there was QE 2.5. You remember that? What an abortion that was. Okay, that was the Chinese saying, we want to swap all our 10 and 30-year treasuries for under 2-year treasuries, a swap of bonds for bills. And we helped them to do it. The Chinese are not about sabotaging the system. They don't want to be blamed. They're going to let the Americans do it by having corruption, fraud, gold market manipulation, just one crisis after another, and bankruptcy, insolvency of the banks. My gosh, the next big event that was kind of confirmed by The Voice a few months ago is the shale and fracking sector. Wall Street's keeping that alive with a radically low, inadequate oil price. But the Wall Street banks might have a couple failures or very serious blows, major losses. Like we have to announce a $4.5 billion loss. We can't get it. That's what we're going to start hearing. But let's start moving forward now. I got you up to about the time of the Russian sanctions. When the Russian sanctions came in 14 and 15, I made a critical forecast, Chris. I said, watch the Germans flip east. It'll take about 3, 4, 5 years. Watch them step by step to flip east. Don't want to lose track of the time here. So the Russians invited the Germans to move plant and equipment and to build subsidiaries inside Russia. And I believe the Germans used treasury bonds in order to finance some of it. Some aid. I might be a little bit off on that, but whatever. What it did was it enabled Germany to do workaround. And the workaround enabled the Germans to say, we built that Daimler-Benz in Russia, so we're going to take it off the ramp and deliver it to a Russian destination for final sale. No violation of sanctions. We built it in Russia. So it's not from Germany to Russia. Where's all the paperwork? No. They built it in Russia. Okay, so there was a lot of that. You had maybe 20 companies build subsidiaries in Russia. And the result is less dollar trade, less need to hold dollars in their central banks. And it's all very exciting, but it's all very deadly for the dollar because there's less and less usage. And now we're at a point where we got so much debt, we got so many one-time charges, we got so much deficit. We've got a fiscal crisis, which is the official name for a U.S. government financing challenge to cover their deficits. We cannot finance our deficits anymore.
Right.
I'd like to take a pause here, if you don't mind. I will get to your question of, how's it going to fall apart? Help me with that question again that I wanted to get to. How is it going to break up?
I mean, is it headed towards, continuation where it's like these things are happening now, yet to the majority of the people in the world, they haven't seen gold or silver skyrocket or life change in a more public way? Is it going to be a slow and gradual, or are we going to have a Lehman moment, or a Sunday night reset or something where it's just, all right, people wake up and now they know something is going on?
Yeah. Okay. All right. I've got the question in mind. Let me take a little pause here, not to go to the bathroom, but to explain something. I couldn't weave it in, Chris. Pardon me. There's no way to weave in fraud of Costa Rica with central bank activity. Costa Rica is an interesting place. I don't regret coming here as much as I regret taking investment risk. And it started out innocently. I want to keep this kind of short. It started out innocently with some nice charitable projects, like a room addition for my lady's aunt. Her two kids could have a little bedroom for themselves. Did some other minor projects. They worked out well. And I thought, well, this dollar issue, here we are, 2010, 11, post Lehman, and things are kind of falling apart, held together by QE glue, which is basically Zimbabwe-style banking. This can't last long. So I don't know what's going to happen with the newsletter. I better start developing some independent income. So I started branching out a little bit, and I got hit with some fraud and had to really struggle to stay alive financially. Because, during all this gold market suppression, the non-believers say, Jim, I'm getting kind of tired of all this. I've been patient, but I'm just getting off the gold wagon. So the subscription base went down. It's still sizable, but it went down from the peak in 2015. So the donate button was put on board in July, and it's been working pretty well. And I invite people to help me out, because whether you think it's a string of bad luck and bad decisions or a demonic directed attack at me, I need help. 6 or 8 months ago, I almost shut down the newsletter because I was 10, 15,000 a month in covering the losses. That's my speech. I hope people can go to the golden-jackass.com site. I'm losing my my voice here. And help me with a donation. I'm just amazed. There have been a few hundred of them since June. It's been quite nice. I hope it continues. I'm going to have a tough decision. When do I call an end to this? Because it's been very helpful. I've climbed out of a hole, and now I'm standing outside on regular ground, and I'm one by one getting rid of debts. You got to have a mental attitude of, I think of a white sphere that I'm operating in. I like to say it's a white sphere with little golden tinkles. This is tough. This has been one of the most difficult and arduous periods of my life. And at the same time, I'm doing noble work.
So that is part one of my interview with Jim Willie. As you can see, I do have his website pulled up in the background here, golden-jackass. You can see big yellow donate button there. So if you really enjoyed what Jim was sharing so far and you're able to please go ahead and go over to his site, make a donation. And with that said, we'll wrap up part 2 on Monday, where he gets into really how all this stuff is playing out now. Part 1, he got into a lot of the history that's led to where we are now. But part 2, he talks about how it plays out, also gets into silver, which was nice to hear. So hit that subscribe button and you'll be posted as soon as it's ready. And hope you have a great weekend and see you soon.